Well, good morning and welcome to the Experian Quarterly Business Credit Review for Q2 2021. My name is Gary Stockton and welcome aboard for another Quarterly Business Credit Review. If you are looking for a copy of the slides, we've left a PDF in the download section, in the handout section. You should see that file there. We'll also send a link to that in any follow-up email that we do from this webinar. And this morning, we're going to be focusing on the results from the Main Street report, the key insights in the Experian Moody's Analytics Main Street report for Q2 2021. Our presentation today is going to be broken down into three segments. Presenting for Experian is Brody Oldham. He's the Senior Director of Analytics Consultancy at Experian. And with Moody's Analytics, we have Ryan Sweet. He's the Senior Director of Economic Research. And then joining Ryan is Derek Grunfelder McCrank, an economist with Moody's Analytics. Remember to send us your questions. We want to make this as interactive as possible. There's probably going to be a lot of questions today, I would imagine, with so much happening in the economy. So please submit those as the presenters present their material, and we will sift through those and try to answer as many as we can near the end of the program. And now I would like to turn things over to Ryan from Moody's Analytics. Ryan, take it away.
Thank you very much, Gary. And I apologize, I'm an economist and technology and I don't get along really well. So for some reason, I can't figure out my video. So I'll be the Wizard of Oz today and the voice behind the black box there. I want to start off by giving you a few numbers. GDP growth this year, so gross domestic product, the value of all goods and services that we produce, is going to rise around 6%, which is a very, very strong growth rate, among the strongest since the 1980s. And that growth was really attributed to the reopening of the economy, the fading impact of the pandemic. But growth's going to moderate. That's not sustainable. So we're going to see GDP growth next year closer to 4%. In 2023, we'll get down to closer to 3%. So, over time, we're going to settle down closer to the economy's potential growth rate, which is closer to 2%. But we think that the deceleration is going to be gradual and orderly, and it's just, again, getting back to the idea that you shut down the economy during the pandemic, we're reopening, got this big burst of growth, and things are going to start settling down over the next couple of years. From an employment perspective, we think the economy will achieve full employment, which is consistent with a unemployment rate around 3.5% by the end of next year, a prime age employment to population ratio at 80%, which would be late next year, and that's the key criteria for the Fed raising interest rates. So we'll tackle that in a few slides. But there's lots of good news in the economy, but more recently, there's been some weakening, and that's all attributed to the Delta variant. In the next few months, we're going to see a lot of volatility in the economy because of the Delta variant, and also Hurricane Ida that delivered a significant economic blow to Louisiana, and then later the Northeast with a lot of flooding. But on the slide that you're seeing here, on the left-hand side, this is showing you the impact of the Delta variant starting to show up in a lot of the high-frequency data that we're keeping very close tabs on. With the pandemic, it increased the importance of very high-frequency data. So we're now looking at daily data from Google. We have data from Homebase. We look at Open Table, seated dinner through Open Table. And this gives us a good read on the economy's fluctuations around the pandemic. And what you can see is that, on the left-hand chart, you see mobility at retail and recreation, transit stations are starting to roll over. And again, this is attributed to the Delta variant. We've had cases over 100,000 daily confirmed COVID cases over the last several weeks. This is starting to affect people's psychology and their behavior. It's affecting businesses' behavior, which you can see in the orange line, and this is mobility at workplaces, which has been essentially flatlined for most of this year. And the Delta variant has slowed the return to offices, and you can see that in the mobility data. We're also starting to see it in a lot of data that markets pay very close attention to, and that's on the right-hand chart, and that is showing you growth in non-farm payrolls. And in August, we created a net 235,000 jobs. That was well below most economists' estimates, but we got to take this number with a grain of salt. August, I like to describe August as the only things that are guaranteed in life are death, taxes, and a disappointing August employment number. And I don't want to get too much into the weeds, but there's a lot of noise around the August number because of a low response rate. But still, if you look at the last couple of months prior to August, we're creating around 1 million jobs. Job growth is going to pick back up, and the key is going to be labor supply. It's not a demand issue. We have 10.9 million open positions. So we have a boatload of open positions. We just need the labor supply to pick back up and make it easier for businesses to find qualified workers and workers to fill their open positions. And you can see the hiring difficulty across businesses survey. So for one, this morning we got the National Federation of Independent Businesses survey of small businesses, and the share of respondents that were saying it's difficult to fill a position or have one position that's difficult to fill continues to climb, and it's among the highest we've seen since the survey began. So it's very, very challenging for businesses to fill these open positions, but the takeaway is the job markets continue to heal. We still have a long ways to go. We're not back to pre-pandemic levels. It's going to take another 12, 16 months before we get there. But the job market will fully heal from the pandemic and the recession. We're just going to have some ups and downs in job growth, given that the economy's prospects are still tied to the pandemic. And you can see that on the next slide. So this is the economics of the Delta variant, and unfortunately, the economy's path going forward is still tied to the hip with the pandemic. And on the left-hand side, you can see the share of the population 12 years and older that are vaccinated. And the U.S. has made a substantial amount of progress, but there's still room for improvement. And the vaccinations are key in mitigating some of the economic costs of the pandemic and the recent Delta variant and future variants. And you can see that on the right-hand side. This is the share of the population 12 years old and older that has received at least one vaccination. And what we want to focus on are the states in red. And we created a back to normal index with CNN. And what that index does is it takes a lot of the high frequency data that I mentioned earlier, the open table seated dinners, Google mobility, weekly jobless claims, our GDP tracking estimate, which is updated daily, and also the home-based data on percent of people that are working, hours worked. And we take all that data, use some statistical analysis, and create an index of where we are getting back to normal. And unfortunately, you can see in the states in red, this is where you've seen a lot of weakness. So the Delta variant is having uneven economic costs across the country. Northeast, most of the West, holding up very well. The South, particularly in Georgia, you can see it in Florida, their back to normal indexes are starting to really weaken. And again, this is mostly attributed to the Delta variant and the economic costs that it's having. It's altering people's behavior. Unfortunately, schools are either some schools are going back to virtual or closing altogether, and that's delaying the return of some of the labor supply that's been problematic throughout most of this pandemic. So unfortunately, the economic costs are going to be uneven going forward until we're on the other side of this wave of the Delta variant. And our baseline assumption is that we're going to get on the other side of this soon, and that's based on the experience that occurred in the United Kingdom. They seem to be 2-3 weeks ahead of us. So things are improving there, and we're anticipating a similar path the US will be on over the next couple of weeks. But unfortunately, there's still going to be some near-term economic costs. We've trimmed our GDP forecast for Q3 because of the Delta variant. But again, when all said and done this year, it's still going to be 6% GDP growth. It's hard to complain about an economy growing 6%. We don't think the Delta variant is going to set the economy back too much, but it's going to delay a few things. And tops on that list is an increase in the labor force. And this is really key to getting stronger job growth going forward. Again, we have almost 11 million open positions. The demand's there, we need the supply. And the two primary reasons why people aren't re-entering the labor force in larger numbers is first, childcare issues, and I'll get to that in a second on the Parent Trap slide, and healthcare concerns. The number of multi-generational households has increased significantly over the last few decades in the U.S. So people are worried about going back to work, contracting COVID-19, bringing it home to their parents, their grandparents. So healthcare concerns and childcare are 1, 2. Hard to figure out which one's tops on reasons why people aren't coming back to the labor force. It's not expanded UI benefits. We've done a lot of work looking at home-based data, unemployment insurance benefits, the monthly regional employment data, and it's hard right now to find any evidence that UI benefits for keeping people out of the labor force. We had 26 states end them prematurely in June and July. Even in those states, you didn't see a big increase in labor force. You didn't see a significant improvement in job growth. And on the left-hand chart, the pandemic recession in perspective, this is the percent in the labor force over the last few recessions. And you can see we're trailing. This pandemic delivered a big blow to the labor force. And our expectation, which is that dark blue dotted line, is that we get a very, very gradual recovery in the labor force. Now, some of this is demographic related. We have an aging population, retirements are increasing year after year. So the labor force participation rate, the overall labor force participation rate, will not fully recover from the pandemic, but that's more a symptom of an aging population. Now, in the near term, the right chart is more important, the Parent Trap slide. And what we did is we looked at the labor force prime age, so this is 25 to 54, across a few different cohorts. So overall is the blue line, that's everybody. Green is people that don't have young children, and the orange line, which is the important one from a labor supply perspective, are the labor force among those that have children under 13 years of age. Now, homeschooling, virtual learning, closures of daycares, summer camps, all of this was a significant weight on parents. And our expectation was, with the new school year starting in late August, early September for most, that we were going to get an increase in labor supply. That means this speed limit for job growth would be removed. Businesses would have an easier time filling open positions. This is still going to occur. It's just going to occur a little bit later than what we had assumed in the baseline forecast. So job growth through the rest of this year may be, mediocre. It's still going to be, strong relative to pre-pandemic, but from the perspective of, 11 million open positions and where we are relative to pre-pandemic, it's going to take a little bit longer for job growth to really pick up, but it will once the labor supply issue begins to be less binding. And unfortunately, the Delta variant is going to delay when we start to see an improvement in the labor force. All right, I'm going to wrap up touching on a couple sensitive subjects. First is inflation. People treat inflation as like a 4-letter word, and inflation's elevated currently, but that is attributed to a lot of temporary factors, and that's why we were focused on the left-hand side here. And this is showing you the contribution to changes in the monthly consumer price index from the reopening of the economy. So these are airfares, lodging away from home, which is hotels, motels. It's also rental cars, anything that these face-to-face industries that were significantly affected by the pandemic. Now with the reopening, they started increasing prices. That added a little bit to the CPI. The green line is autos, and this is also pandemic related, but it gets back to the supply chain issue. We have a global semiconductor shortage, and this is causing new and used car inventories to decline very, very rapidly. We have, I think, record low inventories of cars, and that's driving prices higher. This is transitory. All these factors are temporary. This is not a permanent inflation shock, and inflation is going to moderate. In our baseline forecast, we have inflation returning to the Fed's 2% target by the end of next year, and that's consistent with the view that we are in the midst of a temporary acceleration in inflation. There's no reason to panic. Things will settle down as the boost to the economy from the reopening of it fades and the semiconductor shortage starts to get resolved. The semiconductor shortage likely won't get resolved until sometime in next year, but the price implications should begin to moderate. So I know a lot of people are worried about inflation. It's going to be painful for the next several months, but next year we should start to see more modest rates of inflation. And that's consistent with the Fed's view, and that's what's penciled in our baseline. But what's key is the right-hand chart, and this is inflation expectation. There's a lot of ways to look at inflation expectations. You can look at consumers. They base theirs on gasoline prices, milk prices, bread prices, or you can look at markets and market expectations. This is where investors put their money where their mouth is, and they're really penciling in, as you can see by the blue line, inflation moderating over the next several years and getting back to the Fed's target. The blue line is based on the CPI, which runs ahead of the Fed's preferred measure of inflation, which is the PCE deflator. So if you adjust for that, market-based expectations for inflation over the next several years is consistent with the Fed's 2% target. When I would get concerned is if I start to see evidence that inflation expectations are becoming dislodged. But so far, there is not a lot of evidence of that. And that's why the Fed can be patient. And then I'll wrap up with the Fed. And interest rates are going to rise, not this year, not next year, but in early 2023, we have the Fed beginning to normalize interest rates. But if you look at the chart on the right, markets are really pricing in a very gradual tightening cycle. Before the normal tightening cycle for the Fed was they raised interest rates 25 basis points per meeting. This time around, they're going to be very, very conservative. Our baseline forecast has a little bit more aggressive tightening cycle than the markets imply, just because we think the economy is going to get back to full employment. We're going to have inflation slightly above the Fed's 2% target by the end of 2023, and that's going to justify the Fed applying the brakes a little bit more aggressively than what the markets are anticipating. But overall, you can see relative to the Bank of Canada, markets are pricing in a very benign tightening cycle. And that gets back to the idea that the Fed is laser focused on making sure the economy completely heals from this pandemic, and they're not going to tighten monetary policy too aggressively. We are going to get some changes to monetary policy, and that's on the left-hand side here. The Fed's expected to go slow and steady. This is the tapering of the Fed's monthly asset purchases. This is the first move towards removing some of the accommodation that the Fed has put in place following the pandemic. Currently, the Fed's purchasing about 120 billion in monthly asset purchases. That's treasuries and MBS. They're likely going to start in December, letting this decline. So they're going to go from 120 to 105 down to 90 over time. So by the end of next year, their asset purchases will be monthly asset purchases will be zero. Tapering isn't tightening. That doesn't mean rate hikes are coming soon. It's just the Fed acknowledging that the economy's made some substantial improvements, and now it's time to begin to back off. But all in all, gradual steps. Fed is not going to rock the boat, and the economy over the next couple of years is still going to be booming. Job growth is going to reaccelerate. We're just in the midst of another COVID wave, which is having some economic costs. But as with inflation, this too will pass, and the economy will find its rhythm again in short order. So with that, I think I'm going to pass it off to Derek.
All right. Well, thank you, Ryan. I'll start off my portion of the presentation the way that I always do, which is by thanking Experian for giving us access to the wonderful data that they have. So being able to look at 7.5 to 8 million small businesses from quarter to quarter is incredibly powerful for getting an understanding of what's going on with the small business credit market. So we can get 2 levels of granularity that with many other data sets we wouldn't be able to, because they just don't have the depth to go that deep into small business credit. All right, so getting into the meat of my presentation, moderate delinquencies fell off a little bit in the second quarter after a brief jump in the first quarter. So back in the first quarter, I had warned, we might be beginning to see a rise in delinquencies, but we can't read too much into any single data point. And this quarter certainly proved that true. So delinquencies, which have been falling all year, or for the better part of the last year and a half, have continued to remain low. They're currently at about 1.2% for delinquencies that are accounts which are 31 to 90 days past due. What was interesting about Q2's delinquencies was that rather than seeing a jump up or a move up in these moderate delinquencies, we actually saw a move up in severe delinquencies. So severe delinquencies have been trending down, as you can see, for years. And in Q2, we finally got a bit of an upturn. And we had this sort of false move before in 2018, where it looked like, okay, the cycle might be broken. Severe delinquencies can't really go much lower. Let's start to look for them to move up a little bit. And now they had hit a 2% level in the first quarter, and in the second quarter they jumped up. So 91 plus days past due is now at 2.3% of outstanding balances for small business credit, which again may be a false positive the way that we had seen back in 2018. But given everything that's happened with COVID, it seems like this might be a bit more of a floor this time and maybe an upturn. But I am going to be watching closely to see if this is the beginning of a floor for these severe delinquencies, because they do have to stop at some point, coming down after everything that happened in the Great Recession. These very far past due accounts have to move through the charge-off process or the cure process eventually, so lenders can't just keep rolling them forward onto their books. So watching this for the next couple quarters is going to be something that I'll have my eye on closely. And at this point, I want to touch on a topic that Ryan had mentioned. So inflation, which is something that has been talked about a lot in the economy and financial news lately, and how it impacts small business in particular. So small businesses typically try to avoid credit for the business themselves, so they aren't really seeing the benefits of their debt being eroded away by higher prices. For the most part, this inflation will hurt small businesses and make it more difficult for them to service their debt. And we are seeing that over the last couple of months, small business owners have been increasingly reporting inflation as something that they're worried about. So these higher prices that businesses are experiencing are starting to affect their psyche a little bit. But I do have to agree with Ryan that this isn't something that we're looking for to be transitory. So from a business perspective or small business perspective, if I were going to be looking for a more sustained lift in inflation, I wouldn't be looking at the inflation reporting in the NFIB survey. I would be looking more at the labor cost side of things. So if we were to see a large upward movement in labor costs, so wage cost push inflation, that's something that would lead me to believe this is more of a sustained thing where businesses are having to raise their wages quite substantially in order to compete in the labor market. Right now, a lot of what we're seeing from businesses is they're having to pay higher prices for raw materials or materials provided or intermediate goods, provided by other companies. So this inflation number that we're seeing reported by small businesses is something that goes up quickly, but also comes down quickly. Something on the labor cost side, as I said, would be much stickier in terms of inflation and be likely to have a greater impact on those downstream inflation metrics that we see, like CPI, PCE. So keeping your eye more on the labor cost side and looking for that cost push inflation is going to be important for small businesses going forward. The inflation stuff, a lot of this is really impacted by commodities, particularly lumber, which has come down recently. It's still somewhat elevated from its levels in, say, 2018, 2019. But those commodity prices, which have been fluctuating so much, are what I suspect is impacting the psyche of these business owners, reporting inflation as their concern, more so than something longer lasting like labor costs. So I just wanted to get that in there and throw that out as a reason why, small business credit, from an inflation side at least, isn't likely to see performance deteriorating from this type of an issue, because it doesn't look at this point like it's going to be a long lasting issue. Returning to our credit data, so on the moderate delinquency side, that 31 to 90 days past due, the Mid-Atlantic and Plains regions have been the worst performers for Q2. This is true across several industries. We did see some industries moving against this trend, but for the most part, it was a pretty broad-based movement up there. And throughout the rest of the country, we really saw a lot of downward movement in small business delinquency rates. And this is true, as I said, across most of the nation and across most industries. So the other big thing I want to focus on this quarter is on the PPP side. So we've reached the point where small businesses are starting to apply for forgiveness of their PPP loans. And as you can see in the chart on the left, the vast majority of businesses are having 100% or even sometimes more, like the fees associated with their loans, forgiven as well. You'll notice in the chart on the left, there's just a little bit of activity going on below 100% of the forgiveness. So the chart on the right really zooms in on this. So I restricted it to looking at small businesses where 95% or less of their PPP loan is being forgiven. So in some cases, as you can see from the green section of this chart, new businesses that are less than 2 years old are having less than 100% of their loans forgiven in some cases. While this is a little bit easier to stomach for some of the older businesses, those in sort of the goldenish color, golden green color, I guess, section of the chart, those businesses that are more than 2 years old, this can be a little easier to handle. But for those especially young businesses, it's a little confusing why their loans aren't being forgiven at 100%. So one of the things that I'll be asking about on the next slide, we have a poll question. So I'll ask you all how forgiveness is looking at your institutions. So Gary, can we pull up that poll question? All right, so at your institutions, have you experienced PPP forgiveness rates which were below 100% of the approved loans? So you can answer yes, just in 1 or 2 instances, yes in multiple instances, or no, all the loans you've seen have been completely forgiven. So I'll give you guys a few seconds to answer that. And one of the reasons I'm looking at this is just thinking, in the instances where these loans aren't forgiven and where fraud isn't at play, are these balances going to be coming into more of the regular small business credit market? Are businesses going to be forced to take out a new business credit card or line of credit, which we would then see appearing in our data more so as their loans aren't forgiven? So they have to take out a loan to pay off what wasn't forgiven from their PPP, is essentially what I'm thinking about right now as far as these forgiveness rates below 100%. Okay, so the results look pretty much as I expected. Most of you are seeing just 1 or 2 instances of below full forgiveness happening. A majority of you are seeing that loans are being forgiven completely, and just a few of you answered that there are multiple instances of loans not being forgiven completely. And this is, again, true in the data. So what we had seen before, the vast majority of loans are being forgiven at 100% plus rates, and then just a few of them are being forgiven at below full levels. So I'm going to move on to our next slide and try to wrap this up so that we can give Brody enough time. Figures. The Economist, as Ryan said, we can be a little tech challenged sometimes. My apologies. So this chart is just showing the trend in PPP forgiveness over time. So up until about April, we had seen very little uptrend in PPP forgiveness. A lot of businesses didn't even want to explore forgiveness at that time. It wasn't at the 24-month cap. We still aren't there. So a lot of this is going to be happening next year, towards the end of this year and into next year, really. But what I did think was notable is that just at the very end here, we are seeing that forgiveness has been picking up lately. So you see that right in the June-July horizon, you don't see instances of days without any forgiveness anymore. You see this one massive outlier of a day where over $30 billion worth of PPP lending was forgiven. And then after that, you don't even get that bounce back to zero, any sort of payback for that outlier day or week, rather. So we are starting to see a pickup in this PPP loan forgiveness. So for all of you, I'm sure you've been seeing, increasingly businesses are reaching out about processes that banks and lenders have for getting their loans forgiven. So this is increasingly going to be a theme moving forward. So in our next quarterly update, we'll probably talk a little bit about PPP forgiveness and what's been happening with that, because we do expect it to pick up over the next few months. And then moving into my last poll, and then we can I can hand things off to Brody.
Yeah, there's 2 in there, Derek. Is it the delays?
Yeah, I didn't know if they would appear together or not. If we can go to the delays and forgiveness, yeah.
Yeah, we can show that. Yeah, let's launch that one.
All right, so first question, have you experienced delays in PPP forgiveness? So we've heard of some instances where forgiveness is taking much longer than it was anticipated would be the case. So when the SBA was rolling these programs out, they had, they moved very quickly in order to get things up and running, get money out the door. But now that it's time for forgiveness, it seems like there might be a little foot dragging. So I just want to get a sense for whether you've experienced any delays, so significant delays which are ongoing, so more than just a few weeks waiting for a result. Yes, you've experienced delays, but they've been resolved, or no, you haven't had any trouble getting your PPP lending forgiven. So let's give it just a few more seconds, Gary, and then let's go to the results. All right, let's move into the results. Again, kind of as I expected, though the number of you who have delays which are ongoing is a little surprising. So I guess as more and more PPP lending is coming in, the number of delays is going to, or maybe increasing. Again, this is a reason why we want to look at this again in the next report or in our next webinar. Some of you have had delays, but they've been resolved, and more than half of you haven't had delays. So if we can just go to the last poll, Gary.
You got it.
Cool. All right. So for those of you who have experienced delays, what portion of loans have been affected by delays? Less than 1%, 1 to 2%, 2 to 5%, or more than 5% of loans that have applied for forgiveness have experienced delays in processing. All right. Give them a few more seconds for some results to come in. All right, I think, Gary, do we have a good response rate?
Yeah, we got about 18%.
Okay.
18% voted. Let's go ahead. We'll close the poll just for the interest of time here. I can see the trend, and I'll share this.
All right. Looks about as I had imagined again. Pretty monotonic, decreasing. So 57% of you answered less than 1% of your loans have been affected by delays, 21% at 1 to 2%, and then it falls down and tied at 11% for the 2% plus. So it seems like about less than 2% of loans are experiencing delays for the most part, and any more is a bit of a rarity. So this is good news for small businesses. And again, just thinking towards the future, if they aren't forgiven, if there are delays, will these businesses need to turn elsewhere for credit to tide themselves over in the meantime? So that's something to keep an eye on as we move forward. But that I've actually gone a few minutes over time. So Brody, I will turn things over to you, and we can take a more in-depth look at what's happening with small business credit.
Not a problem, Derek. Really appreciate you joining us today, as always, and providing insights. You and Ryan giving us some great thought leadership into what we should be looking for, certainly in markets and how that impacts small business. So thank you. Well, today we're going to dig a little bit into small businesses and take a look at how business owners are impacted and how that is translating into small business impact. I'd like to start by reviewing, since we have the opportunity to look at some great small business or a great consumer data as well as small business data, I like to look at business owner information. And so to do that, we look at our Experian consumer trends, and these cover our originations for mortgage, auto, bank card, and personal loans here. And you can see that for several months, we've seen an upward trend in most of the originations in these types of products. Now, the ones that are products that small business owners use for additional equity and getting some cash injection into their small business in times of trouble, like mortgage, we've seen a drop off there in originations. Those have dropped down about 19%. You can associate that with some of the commodity prices going up we saw earlier in the year, inventories being very low, and we've seen just difficulty getting through the process of originating new loans in certain markets. So that's really creating some challenges. We've also seen a lot of properties held up with the eviction moratorium. We'll probably see, as we go forward, as that moratorium has come to an end, we'll see some landlords, that have been underwater for a while begin to sell those properties. So we may see some additional inventory enter the market. And we look at delinquencies, just like Derek saw for small businesses, we see it for consumer as well. Those delinquencies continue to drop month over month. When we look at the trends here, you can certainly see that continuing to be low. Now, one of the things I want to direct your attention to as we look at the map in the middle, if you think of Ida and Elsa coming through. I always have to remember that Frozen reference. Elsa coming through the United States. Generally, they come through our Gulf Coast, up through the center of the U.S. and up toward New England area. So you'll see that a lot of the states that are impacted in consumer delinquencies follow that same path. So we're certainly going to be watching those as we go forward. So one of the things, I'm getting a little echo here. I'll wait just a second.
Yeah, I'll just mute. Go ahead.
All right. Where I'd like to direct your attention here in the forbearance loan modification section, when we look at consumers, how much stimulus is flowing in, where they're able to take some of that payment stress off themselves during the pandemic. A lot of lenders created programs to be able to accommodate some of those. What we're seeing is that those natural disaster and payment deferrals are the ones that are really trending down and will have more closeouts at the end of 2021. That means some of those payments will be back on consumers, so their ability to spend will be tightened a bit as we come into the end of 2021. So we want to be aware of that. You know, consumers are a little tense. Certainly with COVID picking back up here, not being able to get out as much, going back to work, slowing a bit, getting back out to their normal lives is a little bit of pressure there. So they're feeling that tension, and that's slowing spending just a little bit, putting some additional pressure on that area. What you're going to also notice is that fraudsters are back out there. And, you know, as stimulus kind of slows and the ability, you know, we talked about PPP loans, as fraudsters turn their direction back onto consumers and small businesses from those stimulus programs, we're going to get more calls. I got another IRS call where they said they're going to send the sheriff to my house again. Always get those. And if you don't know your policy on your auto loan and your policy for fixing your car are up for renewal, so you need to go do those too. All those come in as fraudulent calls. You'll start to get more and more of those as we get into the end of the year. Fraudsters are really picking up the pace here. As we get into evaluating stimulus packages, I just want to point you to a few of these here. On the right-hand side, we'll see that infrastructure bill still held up a bit. There'll be a vote on this on the 27th, hopefully. I think that's where we have some initial commitment for a vote in the House as we move forward. That decoupling of the budget and this infrastructure bill has helped to move it forward and get us a little closer. That infrastructure bill will be important to our construction industries and service industries around those, and we'll see some of the impacts that's already causing in the delay. As stimulus money has run out for PPP loans, we're going to see a waiting on that stimulus to come in from this infrastructure bill as we move forward. Eviction moratoriums certainly going to create some challenges as we go forward. Those eviction collection, we'll see that with energy having an impact on small businesses. Again, as those moratoriums end toward the end of this year and then through April, what we'll see is, again, that debt being reassumed by the small business, and their ability to go out and continue to use that money to grow will be restricted a bit. Now, when we look at installment loans, we look at the trends from a lender perspective. What's good to see here in this top right hand is that for installment lending, we've seen originations on an upward trend. They continue to move upward. This is above their normal level. You'll see that delinquencies are still low. We had a little bit of a kick up toward the end of the year. Some of that was due as we were coming through the pandemic. We had a stimulus gap and then picked back up in December and January, and so some of those delinquencies were raised there. We expect to see that delinquency trend pick up a little bit as the market expands and as lenders get out there and really offer more products at just some exceptional deals for small businesses to go out there and get some loans from a private entity versus getting it through stimulus. Their cash flow will change a little bit, and small businesses will be looking for that growth opportunity, changing from the protectionist of, you know, COVID's coming and our foot traffic slowing to I want to grow my business. And we've really been looking at that over the past couple quarters, and I think we're going to see more of that as we get into next year, as our expectation is that COVID will pull back here, like Derek and Ryan submitted in the next 2 weeks or so. As we continue to look at risk tolerance for lending, you'll see this looks at our origination risk. You'll see toward the right-hand side that we get a little bit of a dip in our May and June timeframe, just showing that our lenders are digging a little bit deeper. We certainly hear that sentiment coming back from our partners as they look for opportunities to grow their portfolio as reopening continues. What you'll see here, again, is looking from a portfolio view across industries. Some of the key things to point out will be construction, which we talked about a little bit before, supply chain challenges in retail. So you take it all the way from the commodity original to creating the products to shipping them, and we know that shipping lanes are jammed at this point. Containers are hard to come by. Getting them into port and transitioned to the areas where they're needed and where small businesses can pick them up from the wholesalers and move forward to the consumer. That whole supply chain is challenged at this point, and that's where we'll see some of this tension and delinquencies rise a bit as we go forward into the fourth quarter. I'm certainly looking for how this will create some impact and some additional shortages as we get into the holiday season. Now, one thing that I'll talk to here is as far as looking at our commercial card growth. Now, unsecured lending is important to small businesses. It's a way to get some credit quickly. I talked a little bit with Ryan and Derek on, if these PPP loans are not forgiven, how do you get credit to cover some of the balances there and to move forward? And unsecured debt is certainly a way to do that. We've seen credit cards for commercial lines really pick back up since the end of summer last year through today, and you'll see that trend here in the upper right-hand side. Delinquencies have remained fairly stable and pretty low. As we continue to grow, we'll see those delinquencies pick up. You'll see in the bottom right, that expansion into a little deeper risk tiers. Our lenders are using some more advanced methodologies, getting a little deeper into segments that they might not have before, and that'll create some additional risk as they go forward. And so you'll see them getting a little deeper into strategies and really making some offers as they're out there trying to grasp back and pull back in a lot of those growth metrics that they had lost during the pandemic as they pulled back into their recessionary policies. Again, here on the bottom left, you'll see that delinquencies remain low and stable, a little uptick as we saw coming into the summer, but as expected, again, as these growth metrics continue. So again, a couple of things to point out here. One of the other ones that I would point you to, we talked a little bit about constructions, we've talked about retail. Take a look at wholesale as well. So that's that preliminary step. When you think about wholesale and transportation, as the supply chain binds up a bit and we see challenges, with Delta or COVID spiking a bit, you'll see manufacturers shutting down and reopening, policies on how to work with vaccine requirements for certain areas. That's going to cause some pressure on the system and will create some slowdowns in filling those warehouses, getting the inventory back up. And we look at it certainly as a challenge for these businesses as we move forward. And we're going to look specifically at an example here when we think about the holiday season coming up. We're getting into that time. This year has gone super fast, and we're already into some pre-shopping with Labor Day. We had that slow down just a bit. Some pressure was put on that since COVID was spiking at that point. We saw it slow down in foot traffic. You'll see U.S. orders are down for factory orders down a bit. Manufacturers, trade inventories, they are picking back up, and we will continue to see that trend pick back up. But what you'll notice on the right-hand side is that trend for commercial credit in a retail setting within the retail industry has leveled off a bit as we're getting into this first, coming out of the second quarter, going into the third quarter, you'll see it leveling a bit. I think that's the tenseness that we see in consumer foot traffic, slowing a bit with variant increase. A testing of the waters for small businesses as they prepare to ramp up their inventories for end of the year, or make some critical decisions as they go forward. And the demand is there. It's whether they can fill those orders coming through. So that challenge that we'll have in finding the right balance as we go forward is certainly important. What you'll see is that we've done some breakouts here across gender. We look at diversity metrics as well. It's really a good story as we tell as these get closer and closer together. When we look at lines being offered, we look at the number of originated per different segments, certainly improving, and that's one of the things that has been very important to the market as we move forward, and certainly to Experian and Moody's as we go out to engage with the market and really try to put our best foot forward and help and support our customers. But there are certainly ways that we can do that as we go forward, and we can see the impacts of that already taking shape across the industry. So when we wrap it up, just broadly, we're still seeing that markets are open. Policy holder or owners, those that are creating public policy in local, regional, and at the government level, really trying to hold back as much as they could for as long as they could as the spread continued. But we're seeing mostly local economies open back up. Stimulus and moratoriums are beginning to close. We saw some big moratoriums close down this month. And so that will allow small business owners to make some decisions as we get into the end of the year. We're seeing private funding being used more than it was certainly as the PPP and some other stimulus programs came out. Those are still important programs. We certainly see that small business owners that take up these accommodations and these programs with PPP and restaurant revitalization through the SBA, they are performing much better than the norm. And so we want to keep educating our small business owners, teaching them how to get to these programs and supporting those, because they help from a lender perspective, certainly, to keep those delinquencies low and keep those customers profitable as we go forward. So it creates that win-win scenario across the industry. And our industry focus with our clients has been focused, again, on digitization and customer experience. We certainly look at automation a lot more and the types of solutions that are out there. So as you look at some of the insights that were brought to bear today from Moody's and Experian, you can see these are really actionable insights that we can take forward and help you develop a strategy. And I think that's where our clients are certainly going. How do we make these faster? How do I get our customers to feel like they're, we're open and free to go out, but our experience is going to be just as fast as it was during the pandemic to keep it moving. So I think we're in a good spot. I think we're certainly moving forward as the economy cools a little bit, but that's good. As we go forward, we're still seeing growth and expansion across segments. We're seeing delinquencies really low and historical low in some segments, really working well. So there's an opportunity here for us to continue this growth as we get into the next couple years and really have a good season here to be really growing the U.S. economy. So being a big part of it. All right, well, Gary, I know there's a couple closing things that we wanted to talk to here and get in front of us. So I'll turn it back over to you.
Well, yeah, absolutely. With this episode of this quarterly business credit review, we've actually kind of reached a fork in the road, so to speak. But we wanted to wish Derek Grunfelder-McCrank the very best of luck. This is his last one with us. Derek's going to be moving on to a new job at another company. And Derek's put a lot of hard work into this program. I mean, right from day one, when we partnered on actually it goes all the way back to the Small Business Credit Index and then the Main Street Report. He analyzes, he pores over our data on a quarterly basis and then agrees to come on here with Christian and Ryan and unpack that for us. So we wanted to wish him the very best of luck.
Thank you, Gary. It's really been my pleasure to work on this with all of you at Experian and everyone from Moody's. I've really enjoyed being the small business guy, so I will miss this going forward.
It's been a real pleasure working with you. But Brody, any thoughts, any comments?
Oh, you know, we wish you well, and we've had fun. Really, the insights that you bring to our sessions and even before and after have been fantastic. And we wish you all the best, and we'll keep up with you, and certainly we'll connect. And I know folks on this call that have been following you for a couple years now will do the same. So we wish you well, but we know we'll see you soon. Thanks, Derek.
Sounds good.
And with that, we're going to close this quarterly webinar out. For more information on Moody's Analytics, of course, you can find that at moodysanalytics.com. And of course, you can always find us at experian.com/B2B. We've got Beyond the Trends report coming up in about another week and a half. So Brody will be doing some analysis. You'll be talking about restaurants, right? Those restaurant trends.
I will be.
Okay, so stay tuned for more insights from Experian. Thank you, everybody, for joining us today.